Hey, good morning, everybody. Want to welcome you to this morning's event, the January Effect. It's Monday, January 24th. You got John Hopkins here. Tom Bowley going to jump in just a minute. Looks like we got a great crowd here today. We always love to hear where people are from. So if you could go ahead and tell us where you're joining us from. I see Williamsburg, love that area. Got Georgia, the UK. Welcome, UK. Frigid Seattle. Yeah, but you got something to look forward to at least in the next few days. We don't, not back here. I'll be pulling for you. Michigan, there we go. I'm from Michigan, so go blue. Germany, said Germany. Of course, I'm from Charleston, South Carolina. Foggy Sacramento. It's great, great, great to have everybody here. Look, I want to mention, if you like what you're seeing here, like the video, subscribe to our YouTube channel, spread the word about earnings beats. Our community is growing, and it's because of people like you who've helped to get us there. And by the way, we've got a lot of new faces in here, but we have a lot of our existing subscribers. Many been with us for years and years. We started this company back in 2004, and we got some people who've been with us through thick and thin. It's unbelievable. Like all of our events, this will be recorded. If for some reason you can't stick around, no sweat. We will make sure you get a copy of the recording. I do want to mention very briefly, and we'll talk about it more later, every time we have one of these events, we want to reward people. We have our flash sale where you can save a lot of money for an annual membership. And I'm going to tease you a little bit and say this time around, it's got a really big perk with it that's coming. So you can kind of think about that a little bit. But if you want to take advantage of it, you can go right to our website, earningsbeats.com. You'll see a link to flash sale. You can go ahead and get signed up, and it'll be well worth your purchase. But anyway, stick around for the perk that I think Tom's going to get everybody excited. How you doing this morning?
A little frigid here south of Charlotte, North Carolina. We got a big storm coming in.
Yeah, well, I see your picture with that cap on. That's going to be you later. With it,
Yeah,
no cap.
yeah, that's a different kind of cap. That's usually not the hat that I'm wearing. But in this kind of storm coming in, I'm going to need that and probably a whole lot more.
Get the shovel ready.
Yeah,
right. And don't forget too to have the broom, to wipe off the car.
Yeah,
You ever think about that?
Got to do all that. I tell you, we got mostly ice coming, which is not good. I wish we were getting snow.
Yeah. All right. So anyways, I know there's a lot to cover here. I'm going to step to the side. You're going to bring me back a little bit later so we can talk more about our flash sale, what our perks are this time around. And it's going to be interesting. This has been already a wild. We're not even done with January. It's already been wild. And I imagine it's going to be an interesting year. So why don't I go ahead and step aside? I'll be back in a little bit.
Sounds good. Yeah, welcome everybody. Always a pleasure to do these events. We do like to reach out to our community and try and share a lot of our knowledge, a lot of our research that we've done over the years. I think hopefully you'll enjoy some of this information if you haven't seen it before. If you have seen it, I think it'll be a good refresher. But it's amazing because you always hear, folks talk about the stock market and how it looks ahead. Well, I think the January effect is literally like the poster child of that. It's the whole idea behind the January effect is that in January, depending on which way the stock market goes, it gives us a directional clue for the rest of the year. And you might think, well, how is that possible? What I'll show you some numbers and you can decide whether or not you believe in the January effect or not. But I am certainly a believer. I'm a believer of a lot of historical patterns. Doesn't mean it guarantees us anything, but it's one more piece of evidence when you're trying to put that jigsaw puzzle together about whether the stock market's going up or going down. I do think this is a worthwhile piece of that jigsaw puzzle. So I don't think today's session will take very long. If you do need to leave for whatever reason, it is being recorded. So you can always get your copy. You can come back in and check later. I don't anticipate this is going to take more than 30 to 45 minutes. There's just not a lot of slides. And I don't think it'll take too long to get my point across. So let's go ahead and start moving through here. And take a look first at the agenda. First, what is the January effect? Well, I kind of already explained it. It's really just how the market performs in the month of January, how that relates to historical January performance. And then it kind of puts us in different quartiles, either the best Januaries that we've seen since 1950, which is quartile 1, all the way down to the worst Januaries that we've ever seen, which is quartile 4. So it's just going to be in order 1, 2, 3, and 4. There are 76 years since 1950. So there's going to be the 19 best Januaries will be in quartile 1. I'm talking about the S&P 500 right now, by the way. There'll be the next best 19 Januaries will be quartile 2. And I'll show you all the numbers as we go through. But that is in essence what the January effect is. Depending on how we finish the month of January, where does it stack up historically and what that could mean for the rest of the year, simply based on that January performance. We'll go through the analysis of the quartiles, and I'm going to show you not just the S&P 500, but also the NASDAQ and the Russell 2000. And then finally, what does it mean? Where are we right now in terms of January performance? And so once we go through all of this, I'm going to start off showing you where we are in January 2026, but then that'll give us a little bit of a hint as to where we might be heading later this year. So just something to think about as you go throughout the year. So let's keep moving. Going to start off first, just giving you a general sense of each of the major indices that we're covering. The S&P 500 is on the far left, NASDAQ's in the middle, Russell 2000's on the right. You can see that they are, covering different periods. The S&P, we're going all the way back to 1950, the NASDAQ since 1972, and the Russell 2000 since 88. That's when those two indices began. And just kind of showing you first the blue bar for each quartile tells you how the January, what is the average January performance? If you want to be in that top quartile of Januaries, the average is 6.9%. The average balance of the year performance, and I'm talking February 1st to December 31st. And that's a really important distinction because this balance of the year, this does not include this great January performance. This is starting all over again as soon as you go in on February 1st, it's looking from February 1st to December 31st. So the really good Januaries on the S&P 500 have posted really good balance of years. And if you notice, as this drifts lower, January performance, as it drifts lower and lower, notice that quartile performance for the balance of the year goes down quite a bit. So if you're in the top half of Januaries, the balance of the year historically, not every year, but historically, the second half or the balance of the year tends to be pretty strong. But if you're in the third or fourth quadrant, then the tendency is that the balance of the year isn't so great. So January does seem to give us a little bit of clue as to what we might expect going forward. I'm going to go over all these numbers and I'll show you all the data that makes up these numbers in just a couple slides. So the NASDAQ, you can see as the quarterly or quartile performance for the month of January goes down, NASDAQ performance stays pretty solid through the first three quartiles. Not a whole lot of difference in terms of average performance rest of the year. But if you happen to fall in that bottom quadrant and the NASDAQ has a really rough January, you can see the balance of the year is nil, averages almost nothing. So again, if you're having a really bad January, it can lead to a not so great rest of the year. The Russell 2000, I wanted to provide this because there really doesn't seem to be a whole lot of positive correlation between what happens in January and what happens in the balance of the year. It seems like no matter what happens in January, we get an average return the rest of the year anywhere from 7 to 11%. So not really a whole lot of clues there. I mean, I would say that if you're in the first quadrant, that does produce the best balance of the year average return. But really, I mean, you're splitting hairs looking at those returns because, again, those are average returns. So you get all the years that make up that average. They're going to go up and down, and there's going to be some really good ones. There's going to be some not so great. But down here at the bottom, you can see this is our key takeaway here. The top 25% of Januaries tend to lead to stronger average balance of the year performance than the bottom 25%. So if you have your choice, if you're looking at history and you're like, okay, in the history, does the stock market do better if we have a really good January or a really bad January? Because without this research, I would have thought, that if you had a really good January, that you kind of using up some of your gains for the year and that maybe it wouldn't be so great the rest of the year. And then if you had a really bad January and the average return on the S&P 500 is, 9.5% per year since 1950, if you start off January really bad, seems like maybe the rest of the year would pick it up, and kind of recover. That's not the case. Again, you can check this out. Look at the best Januaries. Look at the difference in average balance of year performance between quartile number 1 and quartile number 4 on the S&P 500. And again, these are averages. Each quartile represents 19 years. So there's quite a few years in here. And you can see in the tendency to have a down balance of the year goes up significantly if you've had a poor January. So anyway, those are the takeaways. Let's keep moving. So right now, this is where we stand in 2026. Just to give you an idea, if the month were to end right now, we still have another week. So this isn't a done deal yet. If we have a good week next week, maybe we can move up into one of the higher quartiles, or if we have a sell-off, possibly could take us down into the fourth quadrant on the S&P 500 and on the NASDAQ. You can see right now 0.9% up is a little bit better than the average of the third quartile. So, we'd probably have to lose at least a few percentage points next week, which doesn't seem likely, but I guess it's possible. And the NASDAQ is right on its average for the third quartile, 0.8%. So it's right in the middle of the pack in terms of third quartile performance for January. So this one, we'd have to see the NASDAQ sell off a little bit, but it's possible we could end up into the fourth quartile. And if that were the case, again, no guarantees, but it would start to paint a picture. The January performance would give us an indicator that suggests the balance of the year isn't going to be so great. Something to think about. Now, before I go further on these slides, what I wanted to do, I just pulled up the last 5 years on the S&P 500, and I'm marking two things. First of all, the blue arrow is the month of January. So when we're doing the January effect, we're only considering how we perform during the month of January. And you can see in 2025, I know there was a question in the room asking about how, we finished. And we'll show the numbers when we go into the slides. I can show you where 2025 fit the balance of the year. But we were up in January in 2025, and we ended up finishing pretty strongly. I think we were in the second quartile in 2025, but I'm doing this strictly on memory. Didn't look recently, so I'm not sure. We'll look at that as we go through the slides in just a minute. But right now you can see there, we're just barely up, and we had a rally last week a little bit, which helped get us back above that zero line, which was getting us a little closer and closer to that fourth quadrant. So last week's action helped, but we still have another week ahead. The green shaded area that I have marked there on your screen is something that we talked about at Market Vision 2026. That's our annual forecast for the S&P 500. And we go through a lot of themes, talk about a lot of different things, not just the S&P 500. But one of the mini sessions that we had right before I gave my forecast for the year, talked about a study that I had done looking at the October 27th close to the January 18th close on the S&P 500. And the reason I looked at that, it's been well known, and I've talked about this for many, many, many years. That is historically the best time of the year to be in stocks. In fact, if you go back to 1950, this period, which represents less than 25% of the year, actually about 23% of the year, this period that represents 23% of the year has produced 50% of the gains on the S&P 500 since 1950. That is statistically relevant. So what we did is we looked at that period and said, okay, if we have a really good period from the end of October through January, I broke it down into quartiles, kind of like I'm doing with the January performance today. And I broke that down into the various quartiles, and it's strikingly accurate in terms of forecasting the rest of the quarter, first quarter, and then also the rest of the year, depending on how you perform during these 2 months and 20 days, whatever it is, roughly. It's like 2 months and 3 weeks. But I want you to see, look at January performance, getting back to the January effect. Look at the January performance to start 2022. Remember that nasty bear market we had? We were at an all-time high when we started January. It was one of the worst Januaries on record. And look what it led us to, balance of the year. Pretty interesting. And then after this, nobody wanted to touch stocks. And look at January. January soared in 2023. What did we do in the balance of 2023? We finished on the high, had a very strong year, gaining about 25%. And then January of 2024, strong. And then we had a strong rest of the year. January 2025, we finished up. Wasn't as strong as the last two, but we did finish higher. And after a brief period to the downside, which we talked about, by the way, at Market Vision 2025, before it happened, we talked about the possibility of this selling off. And then now you can see where we are in January 2025. Anyway, I just wanted to kind of give you some interesting facts about this period from October 28th through January 18th. It's actually October 27th close through January 18th. January 18th close. But that's a very, very bullish period. We just finished this period pretty much flat. I think we were up just slightly, which put us in the fourth quadrant, by the way, or fourth quartile, right at the top of the fourth quartile. So right on that borderline between the bottom of the third and the top of the fourth, but we were in the fourth quartile, which doesn't really bode well for performance in 2026. And now we're looking at January to see what January does, to see what kind of what information January gives us. All right, so let's keep moving. This again is where we currently stand. So the highlighted quartile that you see here is where we would finish if we don't move from where we are right now on the major indices through next week. If we finish next week right where we are right now and we end January there, these are the quadrants we would be in. So a little bit discouraging for the S&P 500. The others not so much. Actually, Russell, I think that bodes well maybe for the Russell 2000. All right, so let's talk about the S&P 500 first by quartile. So here were the numbers that we showed earlier, where we had the three indices next to each other, S&P and then the NASDAQ and the Russell 2000. So there's quartile 1, here's quartile 2, here's quartile 3, here's quartile 4. So right now we are sitting in quartile 3 with this 0.9%. And what that tells us, based on all the years in quartile 3, 16% of the years saw the balance of the year go up by more than 20%. 10% going up more than 10% the balance of the year, a little more than 1/3 of the years in this quartile. And you can see each quartile, look at the percentages coming down. Balance of the year was positive. About 2/3 of the years in quartile 3 are positive. But you can see it's up at 90%, almost 90% in quartile 1. 90, then drops to 84, then 68, then 63. Balance of the year is down greater than 10%. In other words, it's a bad rest of the year. Rarely happens if you're in quartile 1 or 2. Quartile 3, it's happened about a quarter of the time. So if we finish where we are right now, there's more of a chance that we go down 20 or 10% than there is that we go up 20%. And then balance of the year down more than 20%. You can see the majority of the years where we've seen balance of the year drop by more than 20%, most of those years reside in quartile 3, with a little bit more in quartile 4. That would be 1 year in quartile 4 and 2 of them in quartile 3. So again, it just gives, we haven't had any balance of years down more than 20% if you fall in quartile 1 or 2. That's 38 different years, 19 in each quartile. Out of those 38 years, if you fall into one of these 2 quartiles, so the January performance is in the top half, we've never seen a 20% decline balance of the year. And we've only seen 1 in each quartile going down more than 10%. So only 2 times out of 38 years have we seen the balance of the year drop 10% or more if we're in these 2 quartiles. Right now, unfortunately, we're not in those 2 quartiles. So we'll see where we finish. Here is the S&P 500. Here are the years in January performance order. So here are those averages down at the bottom under the January column. You can see the average of 6.92%, and then the balance of the year 15.36%. This is where those numbers come from that I've been talking about. Here is the data. So you can always come back and refer to this data if you'd like. So where we sit right now is in 2026 is we're at about 0.8%, I believe. Or no, that might have been I think that might have been the NASDAQ. But basically, we're just above the average in quartile 3. So we're right around in this territory of quartile 3. Now, in order to get into the bottom quartile, you have to be down at least 2.75% for the month of January. And right now we're up. So we'd have to have a pretty bad week next week. But if we did, just remember this, because if for whatever reason January winds up into that bottom quartile, it can be pretty rough. Here was 2022, by the way. Remember the bear market? Minus 5.26% in January, minus 15% the rest of the year. And you can just see a lot more minuses over in here. If you just look down between the minuses and the single digit gains, it's the majority of them. And if you're looking for big gains, with the exception of the one in 2009, which seems to be more of an outlier, most of the really strong ones are up in the upper part of quartile 4. Anyhow, if you look over in quartile 1, you see almost no negatives. Almost everything is double-digit positive. Quartile 2, you start to see a little bit more negatives, a few more years maybe with positive returns, but single-digit. So you can just see it tailing off a little bit. The third quartile, you can see especially down toward the bottom of the quartile, some pretty rough balance of the years. And then, of course, fourth quartile speaks for itself. But bottom line is, better the January performance, the better off we are historically. That was just highlighting a couple of the quartiles there. So we're sitting right now in quartile 3. But if we were to move into quartile 2 or 4, you can see the difference. All of a sudden, the balance of the year starts to improve quite a bit. Not so much if we were to move down into quartile 4. NASDAQ. So again, right now we're in quartile 3. I don't need to go through all this again, but basically you can see the numbers. What really jumps out to me is that you start to get much higher percentages of balance of years that are really ugly in quartile 3 and 4, although we do have some in quartile 1 as well, which is kind of interesting. I guess it's interesting in one sense, but on the other hand, we know that the NASDAQ's a lot more volatile than the S&P 500. So I guess in that sense, maybe it isn't. Now, because this goes since 1972, we've got 54 years of data. So if you break down 54 years, instead of having 19 years in each quadrant, in these, I think we have 13 or 14. So I think maybe in the first one's 14, second one's 13, third one's 13, and the fourth one's 14. I think that's how it was broken out. But you can look at the numbers, very similar in terms of just not being great. If you're in the second half of the quadrant, you just have a little bit more chance of maybe not doing as well. You can just see the tail off is not as severe, it's not as significant. Again, unless you're in that fourth quadrant, things start to tail off a little bit more on the NASDAQ in the fourth quadrant. Here is the breakdown of the various years. So you can check that out. Not really a whole lot to add there. Then we go into the Russell 2000. Again, not as much correlation. I'm not going to spend as much time. The main point here that I wanted to make is that the Russell doesn't seem to give us as much clue anyway as when as the clues that we get on the S&P 500. Now, we are in quartile 1, and the thing that does stick out to me is that the balance of the year has been up 90% of the time if you're in quartile 1, and we are clearly in quartile 1 right now. The Russell 2000 has been on fire so far. Now, all this data, by the way, was done as of Thursday's close, because I know small caps, there were some rotation on Friday. Small caps came down, so I should mention that was through Thursday's close. And then here's your data, quartile 1, 2, 3, and 4, how that gets broken down. Right now, you can see being up 9%. I mean, we're close to having the highest January performance on record on the Russell 2000. And if you look at the balance of the year's returns, there's some pretty good ones. The only one that was down was 2001, where we dropped 3.9% after having a really strong January. And that was the start of a secular bear market back in 2001. You can see most of the really big down years, there was only one down year balance of the year here, minus 3.9. Here was minus 6. Here was minus 14. Here was minus 4. So if you're in quartile 1 or 2, we've not seen any really big sell-offs in the balance of the year on the Russell. And then you get into quartile 3, you see a minus 20%, minus 1, minus 2. And then you go into the final quadrant, you see minus 29, minus 13, minus 13. So maybe if there is one takeaway, it's that if January is pretty strong on the Russell, the odds of really just all of a sudden things turning and being horrible on the Russell 2000, there's not much evidence of that historically. Again, we don't know. This isn't guaranteeing anything. I really want to make sure that is clear. This is nothing more than an indicator. It's like the PPO or RSI. It's just another indicator that I like to use. I love following history. I've done a lot of research on it. I do think that the performance that we see from October 27th to January 18th, that period that I showed you on that S&P 500 right here, that green shaded area. I think that matters. I think, just historically, again, if you do become an annual member, and we'll talk about our flash sale, I believe you can go back and watch, and John, you can correct me later if I'm wrong, but I think once you become an annual member, you can go back and you can look at the Market Vision event and the things that we have done. That was, annual members were able to attend that free of charge. But there's a separate event that just talks about this period. And I think it's very, very enlightening. And because it accounts for 50% of the gains since 1950, I think that it's worth listening to. I mean, this is a period when the market tends to do well. And when it does really well, the rest of the year tends to do very well. When it doesn't, got to kind of be careful and make sure you have your stops in play. And that's kind of what we were looking at here. So I've been kind of anxious to see how January finishes, to see what quadrant. I mean, this, like I said, was in the top of the fourth quadrant or fourth quartile for the October 28th to January 18th period. And now we've got a January that's in the third quartile. That historically, anyway, doesn't bode well for the market. And what we've been seeing of late is a lot of movement away from many of those Mag 7, large cap growth, mid cap growth. Many growth names have been hit hard, and that's what usually drives a secular bull market higher. So we're seeing money rotating away from large cap and mid cap growth, just growth stocks in general. We're seeing money rotate toward value. We're seeing money rotate toward small caps. And as I pointed out in an article over at Stock Charts yesterday, we're also seeing money rotate toward international stocks. So it could be that we're getting information now that's telling us that 2026 S&P 500 might not be what a lot of us think it's going to be. And so just something to think about. So John, here is that flash sale. So if you do have, if you're on your mobile device, you can just scan that, take you right over to the sale. But I'm going to go ahead and also pull up website. So there it is, right on the website at earningsbeats.com. You can click on it and it'll give you all the details, what you can get. The key though here, John, is it's literally only more than just a day and 12 hours. So it's not lasting long.
No, this will be good till midnight tomorrow. And there's a couple of reasons for it, but if you just go to the homepage, you'll find this sale. Number one, our annual membership is normally $997. So number one, you're saving $200. And if you're going to join us, you want to do annual because the monthly membership costs $147. That totals like $1,700 a year. That makes no sense. So, and I'd say 95% of our members are annual, but a couple of reasons the timing's great. Number one, aside from saving a lot of money, I think it's Monday, Tom, we have our earnings, our Q4 earnings event.
Yeah, we do have it. With this storm coming in, I don't want to promise.
Depending on the storm.
Depending on power. I mean, we may or may not be having that event. So I don't want to push too much for that.
Okay. But theoretically, assuming we do, we have these events every quarter.
We will have the event. It might just be delayed. That's all.
It might be delayed a day or two. But anyways, Tom will talk about some of the key companies that have already reported earnings and where you might consider getting involved in them or avoiding them. And then the biggest thing, all the biggies are coming up. This week we got Microsoft, we got Apple, we've got Meta, we got IBM, and then it'll be followed next week, I'm sure, by Amazon and Google. Tom will be talking about those stocks that he thinks have the best chances of making a move up or down into their earnings reports. It's always a tremendous event. Great profit opportunity event. That's number one. Number two, every quarter, Tom does a quarterly market update. So the next one, I guess, will be right around April 1st and March 31st, April 1st, where Tom will talk about what he sees developing the next quarter. Those are tremendous learning events. And the biggie that I'm announcing today is you're going to get access to our Market Vision 2026 event, which was held just a few weeks ago, where Tom talked about the entire year and what his forecast was for the year. That event alone is like $797. So if you sign up for this flash sale at the $797 amount, you're going to get access to that. Not only that, I don't know, Tom, this might be too much, but it gets you into next year's Market Vision 2027. So the perks just are stacked up for this particular event that we're having today. Really, it's number one, when you sign up for a year, it's a great time to have like 4 quarters worth of following Tom. And there's so many events and things going on during that period of time. Plus, when we do have a webinar for annual members only, or any event for that matter, important slides, spreadsheets, Tom shares with members. So anyways, if you're going to do it, you've got to midnight tomorrow to sign up. If you do it today, I'm going to throw a bonus month in. So you get 13 months instead of 12. So do it by today. Today's the best opportunity. Get 13 months. Or you can do it by tomorrow and you'll get your discount. So Tom, that's pretty much it. I don't know what else to throw in.
No, the only thing left to me is
stop me. Oh, I forgot the one-on-one interviews with Tom.
No. No, we're not including those. But in all seriousness, I do think going back and looking, and this is for current existing members, if you weren't at Market Vision 2026, you really should go back and at least review the forecast that I gave for this year, because I'm a little nervous about this year, and it has really nothing to do about history and what we're just going through now and finding out which quartile we're in. That's just adding potentially to some of the worries that I talked about before we ever even started this year. So there's a lot of warning signs out there, and a lot of things that the market is going to have to try to navigate that it hasn't had to try to navigate over the past couple of years. And whether or not it can do that, I'm not sure. But just recently seeing money rotating the way it is into so many other areas kind of tells me that Wall Street, the big Wall Street firms, on the one hand, they're all predicting the market's going to go up next year. But why are we seeing all this big money rotating away from the S&P 500 and away from the NASDAQ and into value stocks and into small caps and into international stocks? I mean, sometimes you just have to sit back and kind of scratch your head and wonder what's going on, because I think the real news, it's not on CNBC. The real news is what we see in the charts and what we see through all of our research. So anyhow, if you haven't checked us out at Earnings Beats, I would strongly recommend you do so. This is a great deal. Like John said, if you sign up today, you get an extra month. So that's 13 months for the price of 12 at an annual rate that is so much lower than our monthly. Anybody who's currently a monthly member or a trial member can use, you don't lose the rest of your trial, by the way. Anybody who's come on as a trial member, if you sign up for the annual today, you get the rest of your trial period plus the 13 months for this deal. So, make sure that, take advantage of these deals. We try to offer them when we have these events, but I'm not sure when the next one will be. So, love to have you come on board, check us out, and send us in some thoughts on the service, from time to time. We encourage that from our members.
Tom, getting back to the market for just a second, I'm going to step out, but it's really interesting how, people often wonder, can the market, advance even if the Mag 7 sits it out, or the big tech stock sit it out? And I think we're seeing the answer, because when you look at the market, there's a lot of stock, the Russell 2000, a lot of Mag 7 stocks are having great moves. And what's happening? The market's not budging. It's pretty much going nowhere. So I think it all comes down to, what's going to happen, to the Mag 7 and some of these other. Look at Intel, with its earnings, got crushed the other day because it didn't quite. And so you start thinking, if any of these companies don't quite meet expectations, which maybe the market's telling us a little bit, it's going to be. Anyways, I want to point out, and I'm going to step aside, but I know one question on a lot of people's minds when you get to the Q&A. Do you have any thoughts on the midterms once and how that might affect the market?
Midterm elections?
Yes.
I don't get into politics. I really don't. I've done some studies, looking to see when one party is, in charge of the White House, the House and the Senate, and when the other party's in charge of all three, and then when one party's in the White House, but the other two areas are split. And I mean, for the most part, the market performance historically isn't a whole lot different. I would say this, that the market historically, if there is an issue with the stock market, as far as politics go, it's normally when one party is in charge of everything. And right now, that's the situation that we have with Republicans in control. So, but it doesn't matter whether it's Republicans or Democrats. And to me, that just kind of makes sense, because I think whenever it's split, we kind of do what's kind of a lot of the policy that goes through is more like in the middle, which I think benefits more people. I don't know. That's just my own thinking. But I mean, I don't get into the individual elections and all that. I mean, I really try to keep politics out of what I talk about. I just look at the money. I mean, if Wall Street's going to include politics, if they're going to include, whatever overbought conditions, whether they're going to include geopolitical risks or, presidential risks or midterm election risks or whatever, it's all baked into the price. The charts show everything. The midterm elections are not anything that Wall Street's not aware of. So I just feel like trying to say that it's this or it's that or what's going on in Venezuela, it's like, no, all those things are already known by the market. So let's just follow the money.
Yep.
And so I don't get into all the, the political back and forth stuff.
Yeah. Well, one thing I want to mention, because there's a lot of new faces here. I'd mentioned that Market Vision 2026 event a couple of weeks ago. And what you don't know is we started those in 2020, and it was a perfect name for it, Market Vision 2020. And we kind of stuck with the theme of Market Vision, but we've been doing this a few years now. And Tom has, I'm telling you, because I study all the other analysts, Tom has been right up on top in terms of his forecast. A lot of people think Tom is a perma bull, but guess what? Tom's mostly bullish because the market mostly goes up. But I will tell you, there have been times when Tom has gotten extremely cautious. And I think in 2022, and warned our members, we get a 25, 35% pullback, and we did. But in this latest Market Vision, I think you're going to be very surprised or interested in Tom's forecast. I'm not going to give it to you, but you'll see it if you become a member and get access to that video, because he is seeing some signs, I think, that a lot of others aren't. And by the way, virtually there's always a couple of analysts who go nutty low, 4,500, 5,000. And 1 year it'll happen out of 100, and they'll be able to say they called it. But the reality is, the vast majority, by far, have the market going up substantially this year. So you want to get a comparison and see Tom, who's been as accurate as anybody, what his thoughts are. You're going to get that by getting access to that last event.
Yep.
Anyways, that about it, Tom?
Yep. That's all I got for today. I do appreciate everybody coming in, and anybody who's a neighbor of mine down here in the South, just be careful, hunker down this weekend, and hopefully the power outages are at a minimum for folks, because that's the thing that's really tough, because it's going to be bitter cold for the South. I mean, I know some of you, we got a lot of friends up in Canada. We start talking about bitter cold, and they're like, wait a minute, that's summer. But down here, the blood thins out. So, we start talking about temperatures in the teens and 20s, and that's pretty darn chilly. But anyway, everybody take care, and yeah, we'll be letting you know on the Monday event, and for members, all of our services here over the next few days to a week, they're going to be somewhat iffy. We'll keep you posted. John, fortunately, is far enough south in South Carolina where John, you're not really expecting to get anything, are you, other than rain?
No, it's going to get really cold like next week, but not expecting much. So I should be able to communicate pretty well.
Yeah. So, yeah, hopefully we'll be able to communicate freely. It's just some of the services without internet or without power might be difficult. Some of the chart lists and things like that might have to be delayed a week or so, just depending on how the weather goes this next few days. But yeah, thanks everybody for coming in. Do appreciate you taking your time on a Saturday. We take our time on a Saturday too, but I really do enjoy this stuff. I really like sharing a lot of the research that we do. So thanks again, and have a great rest of your weekend. Happy trading.